In an era where cryptocurrency continues to disrupt traditional financial paradigms, savvy investors are exploring innovative strategies to maximize their returns while minimizing tax liabilities. One such approach, donating cryptocurrencies to charitable organizations, has garnered attention as a potentially astute financial move this tax season. As the tax filing deadline approaches, individuals who have benefited from the soaring values of their digital assets may find that philanthropy not only fosters goodwill but also offers significant tax advantages. The recent surge in cryptocurrency valuations has left many investors grappling with hefty capital gains tax bills. However, there's a silver lining: donating appreciated cryptocurrencies can alleviate this financial burden. Adam Nash, CEO of Daffy, a modern donor-advised fund platform, emphasizes the generosity of tax codes surrounding charitable deductions. Taxpayers can deduct donations of appreciated assets, including cryptocurrencies, up to 30% of their adjusted gross income in any given year. If you hold crypto that has appreciated for over a year, donating it means you won't incur capital gains taxes, Nash explains. Nash further elaborates that the IRS recognizes the donation's value as the fair market value at the time of the gift rather than the price paid for it. This provision allows donors to benefit from a tax deduction equivalent to the current market value of the asset while avoiding the tax implications associated with selling it. Ephraim Olson, co-founder of CPAI, an AI-driven crypto tax platform, underscores this point, stating, provided all the rules are followed, donating appreciated assets can maximize savings. Donors get the benefit of the asset's appreciation without first having to recognize the tax on that appreciation. This approach is especially advantageous for those who itemize their tax deductions. By donating appreciated cryptocurrency, investors can potentially save money on their tax bills while simultaneously supporting charitable causes. Nash notes, this means more money goes to the charity and less goes to taxes. As the cryptocurrency landscape evolves, so too do the tactics employed by those who wish to navigate its complexities. In a separate development, World Liberty Financial, a crypto venture linked to the Trump family, has recently made headlines by purchasing $775,000 worth of SEI tokens, further diversifying its altcoin portfolio. This accumulation strategy is part of a broader trend among investors seeking to bolster their holdings amidst fluctuating market conditions. Yet, as the crypto world grows, so do the threats it faces. Recent reports from cybersecurity researchers reveal a malware campaign targeting popular wallets used for Ethereum, XRP, and Solana. The malware exploits vulnerabilities in software supply chains, allowing it to redirect transactions to attacker-controlled addresses without the user's knowledge. This sophisticated attack highlights the need for vigilance among cryptocurrency users as they navigate the increasingly perilous landscape of digital finance. In conclusion, as tax season approaches, the option to donate cryptocurrency presents a compelling avenue for investors looking to maximize their financial outcomes while contributing to worthy causes. Moreover, the ongoing developments in crypto investment strategies and security threats underscore the need for investors to remain informed and proactive. As the crypto market continues to mature, both the opportunities and challenges it presents will shape the future of digital asset management, making it essential for stakeholders to adapt and innovate. In a landscape marked by volatility and uncertainty, Bitcoin appears to be on the verge of a significant resurgence, with analysts projecting a possible ascent toward the elusive $100,000 mark. Recent market shifts and strategic movements by major players have ignited renewed interest in the cryptocurrency, suggesting that a turning tide may be on the horizon. As of mid-April 2025, Bitcoin has shown promising signs of recovery, with its price recently surging past the $85,000 threshold. This rebound aligns with broader macroeconomic factors, including a notable easing of inflation rates in the United States, which has contributed to a revived appetite for risk among investors. The price of Bitcoin surged by approximately 2.5% following positive macro headlines, noted analysts, signaling that confidence in the digital asset may be redistributing among market participants. The market dynamics are further complicated by significant corporate maneuvers. Notably, strategy. A company led by Bitcoin advocate Michael Saylor has resumed its purchasing activities after a brief hiatus. Saylor's latest update on social media hinted at this renewed interest following a report revealing approximately $6 billion in unrealized losses in Strategy's Bitcoin holdings for the first quarter of 2025. The firm acquired 80715 BTC at an average price of $94,922 during a quarter that witnessed Bitcoin's worst performance since 2018, with prices plummeting nearly 12%. Despite these challenges, Saylor's firm continues to hold a substantial 528185 BTC, amounting to nearly 3% of Bitcoin's total supply. In a separate but related development, the cryptocurrency market continues to face regulatory scrutiny. A recent case involving a non-fungible token NFT trader has underscored the ongoing challenges within the sector. Waylon Wilcox, a former CryptoPunk investor, pleaded guilty to underreporting nearly $13 million in profits, potentially facing up to 6 years in prison for tax fraud. This case highlights the increasing attention regulators are placing on the crypto space, particularly concerning compliance and taxation. Moreover, the costs associated with acquiring users in the crypto gaming and gambling sectors have been identified as particularly high, underscoring the competitive landscape for attracting new participants. Asaf Nadler, co-founder of Web3 marketing firm Addressable, indicated that these campaigns are the most expensive, with a median cost per wallet of $8.74. This metric is crucial as users equipped with crypto wallets are more likely to engage with cryptocurrency-related products. On the regulatory front, recent decisions by the U.S. government to exempt certain electronics from tariffs have provided additional relief to tech companies, potentially influencing investor sentiment in the broader market. This decision came as President Trump announced reciprocal tariff exemptions for various consumer electronics, including smartphones and semiconductors, coinciding with Bitcoin's price rally. As the cryptocurrency market evolves, the interplay between regulatory actions, corporate strategies, and macroeconomic conditions will continue to shape investor behavior and market dynamics. With Bitcoin's price hovering around $83,700, the question remains, will the digital asset reach the coveted $100,000 mark? Analysts suggest that if current trends persist and as more institutional players re-enter the market, the possibility may not be as far-fetched as it once seemed. In conclusion, Bitcoin's recent price movements, bolstered by corporate buying and favorable economic indicators, suggest a potential bullish trend ahead. As the crypto landscape continues to navigate regulatory challenges and market volatility, all eyes will be on Bitcoin to see if it can maintain momentum and achieve new heights in the coming months. In an unexpected convergence of politics and technology, the landscape of Silicon Valley has been notably influenced by a podcast star turned advisor to former President Donald Trump. This individual, whose voice resonated with audiences through compelling discussions on tech and culture, has now assumed a pivotal role as Trump's tech czar, steering the direction of technology policy during a time of rapid change in the sector. His ascent is part of a broader narrative where the intersections of cryptocurrency regulatory shifts and the evolving role of government are reshaping the tech ecosystem. Recently, World Liberty Financial, a cryptocurrency venture linked to Trump's family, made headlines with a significant purchase of $775,000 in SCI tokens. This acquisition underscores a strategic approach to altcoin accumulation, reflecting the growing interest in alternative cryptocurrencies amid a fluctuating market. The funding for this purchase was sourced from USDC transferred from the project's main wallet to a trading wallet known for prior altcoin investments. The SCI token's price surged more than 27% following the announcement, highlighting the market's sensitivity to such high-profile endorsements. The crypto landscape has been further invigorated by Trump's recent legal and regulatory maneuvers. Notably, he signed a resolution repealing the Biden-era IRS DeFi broker rule, which mandated decentralized finance platforms to report crypto transaction data. Proponents of this repeal argue it fosters innovation and eases the burden on the IRS, while critics warn it could undermine tax compliance. This regulatory shift is seen as a boon for cryptocurrencies, with Binance CEO Richard Tang suggesting that ongoing trade tensions could accelerate interest in crypto as a non-sovereign store of value. Meanwhile, Bitcoin has experienced a notable uptick in value, recently hitting $86,000, marking its highest price in over a week. Analysts attribute this surge to the relief rally following Trump's decision to exempt certain products from tariffs on China. However, traders remain cautious, noting the volatility associated with weekend trading and the potential for further fluctuations as the market digests upcoming economic indicators and corporate earnings reports. As one trader aptly summarized, "If we can remain over $84,000 through Monday, I'll look for higher, but for now this seems sketchy." The intertwining of crypto and politics does not end with Bitcoin's price movements. The Securities and Exchange Commission (SEC) has reportedly paused its legal actions against Binance, reflecting a more lenient approach under Trump's administration. This shift is indicative of a broader trend where regulatory bodies appear to be accommodating the crypto sector amidst its growing integration into mainstream finance. Ripple, another major player in the crypto world, recently settled its drawn-out legal battle with the SEC, further signaling a potential shift in regulatory attitudes toward digital assets. As the landscape continues to evolve, the implications of these developments are profound. From the burgeoning altcoin markets to the shifting regulatory frameworks, the intersection of technology and governance is becoming increasingly complex. With high-profile endorsements and significant financial maneuvers, the trajectory of cryptocurrencies and their place in the broader economic landscape remains uncertain but undeniably dynamic. Looking ahead, the future of technology policy and its impact on the cryptocurrency market will likely hinge on the outcomes of ongoing legal battles and the regulatory environment shaped by political leaders. As the lines between tech innovation and political strategy blur, stakeholders across the industry will need to navigate these challenges carefully, keeping an eye on both market trends and regulatory developments that could redefine the crypto landscape in the years to come. In an alarming development within the cryptocurrency landscape, cybersecurity researchers have unveiled a sophisticated malware campaign that stealthily siphons Ethereum ETH, XRP, and Solana SOL directly from users' wallets. This breach primarily targets individuals using Atomic and Exodus wallets by exploiting compromised packages from the Node Package Manager (NPM), leading to unauthorized transactions without the victim's awareness. The malware's operation is initiated when unsuspecting developers incorporate Trojanized NPM packages into their projects, with one notably identified as PDF2Office. Although it masquerades as a legitimate tool, researchers have discovered that it conceals malicious code designed to scan for cryptocurrency wallets installed on the developer's system. Once identified, the malware injects itself into the wallet's transaction process, surreptitiously redirecting funds to addresses controlled by the attackers. This latest campaign represents an escalation in the ongoing targeting of cryptocurrency users through software supply chain attacks, noted researchers from Reversing Labs who conducted a detailed analysis of the suspicious NPM packages. Their investigation revealed multiple indicators of malicious behavior, including unusual URL connections and obfuscated code patterns that align with previously documented threats. The malware employs advanced techniques to evade detection, showcasing a multi-layered attack strategy. The infection begins when the malicious package executes its payload, targeting wallet software by searching for application files in predetermined paths. Once located, the malware extracts the application archive, modifies the transaction handling code to replace legitimate wallet addresses with those belonging to the attackers, and then repacks the application to maintain the facade of normalcy. For instance, when a user attempts to send ETH, the malware alters the recipient address utilizing base64 encoding to obscure its true intention. As a result, transactions appear normal within the wallet interface, leaving users unaware of the compromise until they verify the blockchain and see their funds have vanished to an unexpected address. The implications of such malware are dire.
Users may not realize their transactions have been manipulated until it is too late, potentially resulting in significant financial loss. This incident not only highlights the vulnerabilities inherent in the cryptocurrency ecosystem but also underscores the urgent need for improved security protocols among developers and users alike. As the digital currency landscape continues to evolve, the incidence of such attacks are likely to escalate, especially as the adoption of cryptocurrencies becomes more mainstream. The growing interest in digital assets, bolstered by legislative discussions such as the recent proposal in New York to allow residents to pay state fees using cryptocurrencies, indicates a burgeoning market that is not without its risks. The integration of digital currencies into traditional financial systems could further expose users to innovative but dangerous tactics employed by cybercriminals. Looking ahead, the cryptocurrency community must remain vigilant and proactive in safeguarding their assets. Enhanced education on security practices alongside advancements in cybersecurity measures will be crucial in mitigating the impacts of such malware threats. As the technology matures, so too must the strategies to protect users and their investments. The path forward will undoubtedly require collaboration between developers, cybersecurity experts, and regulatory bodies to create a safer environment for all participants in the digital currency market. In a week marked by a volatile cryptocurrency landscape, three tokens have emerged as focal points for investors: Solana, Fartcoin, and Arbitrum. With the broader market displaying mixed signals, these cryptocurrencies are drawing attention for their unique performance metrics and potential for future growth. Solana, a leading Layer 1 network, has captured the spotlight due to a significant uptick in its transaction volume. Recent data from Nansen reveals that Solana's transactions increased by 6.6% over the past week, reaching $355 million, while fees surged past $6.15 million. Remarkably, Solana has surpassed Ethereum in decentralized exchange DEX transactions, handling over $15 billion in the same timeframe. This bullish trend has seen Solana's price rebound to around $129, recovering from a low of $94.65 earlier this month. Analysts speculate that if momentum continues, the price could ascend to the 38.2% Fibonacci retracement level at $170. Meanwhile, Fartcoin has made headlines with an astonishing rise of over 364% from its lowest point this year, marking its highest valuation since February 1. The surge has been fueled by whale accumulation and a fear of missing out among retail investors. Chart patterns indicate a potential cup and handle formation, suggesting further upside could see the token targeting key resistance at $1.50. Arbitrum, another token to watch, has faced a challenging few months but is now seeing renewed interest. Its DEX protocols experienced a volume increase of over 40% in the past week, totaling $4.6 billion. The network is approaching a milestone of handling $500 billion in DEX transactions thanks to its popular protocols such as Uniswap and PancakeSwap. However, Arbitrum's price has struggled, down 87% from its all-time high, largely due to regular token unlocks. Yet, technical indicators such as the formation of a falling wedge pattern and bullish divergence on the Awesome Oscillator suggest a potential reversal may be on the horizon. In addition to these established players, the market is buzzing with excitement around Solaxi, a new Layer 2 project designed to alleviate congestion and scalability issues within the Solana network. With nearly $30 million raised in its pre-sale, Solaxi's innovative approach promises to enhance Solana's capabilities, offering reduced fees and faster transaction times while maintaining security. Its unique branding featuring a quirky mascot resonates well with both tech enthusiasts and the broader crypto community, setting the stage for substantial future growth. As these developments unfold, the cryptocurrency market remains in a state of flux. The recent announcements surrounding former President Trump's tariff hold have contributed to a bullish sentiment across risk assets, further influencing investor behavior. Experts suggest that maintaining momentum in Solana, Fartcoin, and Arbitrum will be crucial in the coming weeks, especially as macroeconomic conditions continue to evolve.
Looking ahead, the anticipation surrounding Solana ETFs set to launch in June 2025 adds another layer of optimism, potentially catalyzing wider adoption. As the crypto landscape continues to adapt, investors will need to navigate these complexities, carefully balancing opportunities against the backdrop of an ever-changing market. The coming days will be pivotal in determining whether this week's gains signal a broader recovery or merely a temporary respite in the volatile world of cryptocurrencies.